guys, it is Monday, September the 29th, and last day of the month. Hopefully, this week ends up better than it started. Let's see how the markets are doing. And then I'm going to actually talk about Accenture, which reported earnings last week. And really, it's kind of this really intriguing look at what might be going on in this world from a macro perspective. So you have to wait till the very end to figure out which direction it is that I'm interested in going in. But let's go ahead and share the screen and start talking about it. Past performance, it's not indicative of future returns. We've got a pretty red day. I mean, it has been bouncing around zero all day. I wouldn't be surprised if this thing ends up flat on the day, because like, these reasons that people are coming up with, no one has any clue what's going on right now. I mean, it is just really weird. And as much as I'm not constructive on what was said at the Fed meeting, at the same time, the reason he has to do it is because the economy is so darn strong. Sets up this very strange mode. And I think that's the story that I'm hearing from Accenture more than anything else. Now, here's what it looks like stock by stock. You can see big sell-off in energy, lots of great and interesting theories that people have there. And I think that's really cute, because all of those things would make sense if it was a demand-driven situation, but it is not. It is a supply-driven situation that we're experiencing right now. And actually, in some ways, if this whole situation doesn't start to resolve itself, this supply situation is going to, there's only a few ways that it can play out. And I don't know why people are so focused on talking out about all the ways that that make absolutely no sense, and not really discussing, when it comes to a shortage, who has it should do really well. In other words, who has the stuff that people are short should do really well, and who doesn't should have quite the struggle, so to speak. We got Amazon, Tesla. It's so funny, because out of everyone that should really suck it, it really is Amazon as far as that goes. But nonetheless, here we are. Microsoft, I'm thankful for, because I do have some still residual long position there, and I am very bullish of it when it gets to what I'm gonna call stupid pricing, and so on and so forth. But the rest of the market is really kind of red. All right. Let's get into Accenture and what they had to say that makes it so interesting that I would want to talk about them. Here's the thing. Oh, a couple other things. We've got GDP coming out. It's estimated to be down 60 basis points. It's anyone's guess how much it's down, to be honest with you. I had no idea, And then tomorrow we've got a bunch of home data coming out, which could be interesting. Is mostly going to point downwards, because that's what all the companies have already told us they're going to be doing for the back half of the year. They're not going to be continuing to increase housing starts or anything like that. They're just going to work through their existing inventory. So the fact that this could be any kind of surprise is always a tough one, but for whatever reason, the market likes to print like, oh my God, the economic data was such a surprise, and that kind of is what it is. And then later on this week, we have PCE, which is really the other side of the confidence numbers that came out, consumer numbers, CPI, that came out this week. So that is what it is. We have a couple of earnings this week. Cintas and Paychex are in the S&P 500. I will be watching them like a hawk, because they will give us some heads up as to what's going on as it relates to the business world, because of the breadth for which they cover of the U.S. economy. And we've got Rite Aid, which will tell us what's going on at essentially, it'll give us some insight. Now, Rite Aid is really its own deal. It'll give us some insight into Walgreens and CVS, so we'll watch for that. And then CarMax, always right now, I feel like everybody's looking for a data point on what's going on in autos, because it is a little bit more of a complex dynamic. See my old videos as far as that goes, because I do a whole video on Tesla, Ford, and GM. Accenture, let's get into it. That was a good quarter, okay? Like, there's no other way to say it. And I really want to show it to you. You've got revenue basically up 14.9%, almost 15%. And they brought almost every penny down to the to operating income and on down. Now, I want to tell you that net income was up 17.8%. And there are a couple of things between operating income and net income that make it look a little bit better. Doesn't matter. These are great results. And because they really are closing it out August 31st, what they have to say is one of the more relevant data points that we're seeing in as relates to the business portion of the economy as a whole. Now, I've told you that one possible thesis that could happen here is that you actually have, now, I mean, look, the economists love to use these words, soft landing, hard landing. I feel like that's a little bit lacking in specificity for those of us who must actually cover the US equities companies. So really what I'm looking for is a little bit of nuance from some of these companies. And with Accenture, I'm getting it. And what I'm getting is they have no desire whatsoever or need to lower guidance. Okay. I'll show you that at the very end, but for lack of a better way to say it, outsourcing employment is a thing right now. Okay. You're not bringing, even though we do have still, as described very thoroughly and thoughtfully by the Fed and by pretty much every company this last quarter, there is a bit of a hiring shortage in particular jobs, skilled labor, those that require a particular type of training. It is also the case that when the economy gets like this, the outsourcers tend to do very well because, you know, you don't necessarily want to bring that headcount in. You don't want to spend the HR expense to find the headcount and have to wait that huge time, and then also to bring in the headcount. And additionally, let's just be honest, people that work with a 1099 or are doing this type of consulting work, you know, that is also an effective way to recruit people. That is what it is. So here we go. This is why this business is doing really well. Let's go into the divisions. Now, this to me is part of the reason why I was like, I got to do Accenture today. That's probably the most interesting news that came out that no one probably is thinking about or cares about. There was no region or industry that was weak for them. That's a big deal. Okay. That is a big deal. It gives you a real sense for what companies are going to do to manage through this situation. Now, does that mean that the business community is strong? No, it does not. That is not what I'm saying. But it gives you a sense for what strategies so many are taking and subsequently how it might look as the companies report going forward. So what we are actually seeing, the United States, North America, significantly stronger than, so this is the local currency. So you do have to look at the local currency, and then the effect and impact of the US dollar is here, okay? So when we look at this, the US, North America growing 18%, that's strong. Oddly enough, Europe and the growth markets are also increasing in their own market relative to what Accenture did last year significantly. Now, it's always hard to say, are they taking share because they're better capitalized than other companies overseas? Hard to say. I don't know the answer to that. But regardless, these are some strong numbers across all geographies, which tells you that no matter what's happening, there sure is a lot of consulting work going on. Now, the nature of this consulting work is really automation, upgrading systems, becoming more digital, et cetera. So realize that in those industries, in those areas, still doing great is what it looks like to me. Now, that's regardless of the fact of whether or not one can get headcount or not, which is what company by company these people would be experiencing, and therefore then trying to resolve that employment problem, that labor shortage via the consultants. Now, industry group wise, again, we're seeing massive strength. You know, massive strength. The currency adjustment here is a little bit more helpful because it won't really matter quite as much. It just tells you that quite a bit of this work is in fact overseas. And so still on a global basis, every single industry is definitely doing this set of activities. It gives you a sense for what parts of tech might be interesting as we move into the next quarter's earnings season, which is kind of far away. So we're going to have to bear some volatility here. And then finally, consulting versus outsourcing, it's almost even Steven. So yes, there are folks that are offshoring. And as the dollar gets stronger and stronger, you're going to see that business continue to benefit in certain ways. That will also resolve some of our labor issues to the extent that companies don't find it strategically a problem, as they might have given recent events. But consulting, nonetheless, also doing fantastically, which means there's a lot going on as relates to the companies and what they're thinking to do internally, externally. Now, I don't believe, and it did not sound like from the call that this is the type of consulting work where they're going to fire a bunch of people. It sounded more like it was consulting work as relates to making it greater efficiency. And I call it greater efficiency because it really related to the data pieces and in making the business more digital. So making sales more efficient, making operations more efficient. And so do you want to buy Accenture? You know, right now it's a little bit expensive for me, but it's not necessarily massively expensive. If you're someone who just can't wait or something like that, I would just suggest you put a limit order in. But here's how the numbers fall out. EBITDA, if you do the calculation, basically take operating income, add back in the DA part, DA, depreciation amortization. They actually do have a fair amount of depreciation amortization, by the way, so you can't get away with not adding it back in. They do actually as well have some meaningful debt, so that's about $6 billion in debt. That's the enterprise value. Take those two numbers, divide them, and you get 15 times enterprise value EBITDA. The thing's growing at about, they're saying next year they're going to grow something like 4 to 7% increase is what they're guiding towards, which gives them some room for down and upside, quite frankly. I think they went conservative, but we shall see, because GDP is so strange globally that they're being smart about that. And this number does include about a 6% impact from foreign currency. So really, they're trying to be very conservative about it. Unfortunately, this number puts them at a 23 times future earnings, which for me is a little bit rich. It's not overly rich, given that it's about a little bit over 1, not quite 1.5 times P to growth, PEG ratio. But for me, in this kind of market where everything is coming for sale, I would just wait a half a beat. And that's really the quick and dirty of Accenture on earnings. And I'll go ahead and take questions. How's it going, Dave? Boy, I tell you, Mondays.
Oh, it's a holiday also.
It is. Where's it a holiday? Who's got the holiday?
Rosh Hashanah.
Oh, that's right.
Jewish New Year.
Oh yeah, I should know that. I usually have a lot of Jewish friends where I like keep in touch with that. I was just
Are you back in New York?
I am back in New York. Are you in New York?
Okay. No. I'm back in LA. But
we took shifts. Is what happened.
Oh, I love New York. Okay, let me ask you this. The economy is strong, right?
Yeah.
Which means earnings
from GDP
eventually will be good.
I don't know, because costs have gone up. It's going to be company by company. You're going to get a lot more differentiation. And I think we're already seeing that, because Costco came out fantastic. But what actually took the market down was FedEx, which you'd think would give you some insight into the consumer, because so much of FedEx's business is actually consumer based. They got a fair amount of business, but it's if you look at how it splits out, if you were to say all of this is actually consumer and all of this is, yeah, it's going to be company by company. It really is going to be company by company this quarter.
Okay, but if the overall economy is strong, costs have gone up, but they could come back down. I'm speaking 4 to 6 months in the future.
Everything but food could come back down. Yeah, food doesn't have any chance of coming back down.
And with the exception of big cap tech, which are very interest rate sensitive.
Why do you feel that way?
Well, no, I don't feel that way. That's what I've read. I'm sorry. That's not my idea. No, that's not original.
What are the talking heads trying to say about interest rate sensitivity in the big cap tech? What are they thinking there?
Well, the interest rate, I guess they borrow a lot of money.
That's completely false.
Okay.
We just went through the top 3, and we showed what their debt rates are and how much cash they have relative to that debt. So that's just false.
Yeah, and that's a great point. I was at that conference I was at in New York.
Who
Michael
said
Saylor.
that? Why would they say something like that?
Michael Saylor. They were able to borrow money at 0% long term.
More or less. I mean, 0 is a little aggressive. It's probably like 2% or something like that to a change. But to fuel growth of like 35%, I think they're the only company out there that might ever. But even then, no, they all have, even Meta, as much as I want to make fun of them in different ways at different times, no hate. The man has created amazing business, so it's very hard to get mad at Zuck, I guess is what they're calling him these days. But he's got plenty of cash. Yeah. He's not like the man doesn't have money. He's got lots of money. What he doesn't have.
Yeah, but he's spending a lot of CapEx on that metaverse.
He is, but it's not coming out of, like, if he's doing debt financing, it's only because it makes sense. It's not because he actually needs
cash. It's got to be coming out of revenue, right?
Well, yeah, it all comes ultimately out of revenue, but there's cash on that balance sheet.
Well, I understand that, sure.
They're like way under levered. Yeah. So I'm not sure why the talking heads have decided to make this bold statement about financing in big cap tech. Now, small cap tech is a different story. Yeah.
Well, anyway, big cap tech is getting hurt.
I know.
For some reason.
I really think at some point, I can't wait to hear what BlackRock has to say and some of the big indices have to say, because the way that it looks to me is that there's a very specific pattern. Now, I wish I was a little bit more clever and could just mathematically identify that pattern and show you the exact thing, but it just, I mean, I hope there's got to be other folks out there that are just as that have approximately the same view that I have, but it looks like a very particular type of selling and buying pattern from last week that it looked like a liquidation of certain specific things. And I haven't seen something that looked like that since 2008. I'll say that, the way that it liquidated. And I don't mean like the sell-off was harsh. I don't mean the sell-off was extreme. I mean the pattern that I recognize with my little eyes. Do you know what I mean? But I don't really know how to describe it very well, because sometimes, and maybe I'm imagining it. But I am very interested. I will be listening to BlackRock's earnings call when it comes out next month, because I want to hear what they have to say. I think they probably have on it.
The dollar has been stronger than this before. 2001, it was 110.
Was strong all the way from 1980 until 2000, if people really want to be honest about it. That's what allowed emerging markets to come out. Or actually, I want to say all the way through 2010. China used the US strong dollar to bail itself out of its circumstances. That was a strategic move they made. So, strong dollar,
But I mean, it's closer to the highs than it is the lows. So
oil or dollar?
No, dollar, US dollar.
Yeah. But that's fair. And the reason it's fair is because Europe is such a mess. So I think if you're
right.
Yeah,
but I'm talking in terms of market value.
Yeah, no, I appreciate. I know that, I'm not an FX trader, but the one thing that is readily apparent is that North America and even South America is doing much better than Europe. Asia, no one can really tell, because Asia's always been dependent on China as the wild card. Before 2000, the US held up all economies. And then after 2000, the sheer raw growth of China dragged even India up to a lesser extent, because that's a little bit of a weird relationship the two of those folks have. But China basically held up all of Southeast Asia. And if there's any confusion that was the case, then we need only look at the rise of, we need only look at the pattern of what Southeast Asia did out of the 1998 emerging markets crisis and compare it to Latin America. And that should put any confusion that folks have to rest. But for whatever reason, it's unpopular to give China credit at times for doing that particular set of activities. So right now, we don't know what's going on with China. I mean, conjecture, whatever you want, but let's just be honest. We don't know what's going on in China. And as such, it's very hard if you're a foreign country to want renminbi or yuan or whatever you want to call it these days, and then take that currency over the other reserve currencies, your other choices being the euro, which usually is 25 to 30% at any given point in history of reserve currency. That thing's problematic, let's just call it that. Then you can choose between the yen, the Japanese yen. Why would you choose that right this minute? And you've got the pound sterling or Singapore dollar. If I'm just doing treasury accountant for like XYZ smaller nation, I'm picking the US dollar. Do you know what I mean? So of course it's strong. What's wrong with people? Anyways, whatever. That's all.
I know, but how does that in the long run hurt our market?
Does a strong dollar hurt our market? Depends.
How does it?
It depends. It depends. It depends how you like it. First of all, I think when it comes to global currency movements, that's not my primary expertise. I may have some strong thoughts and some background in it, but what I would say is this: the strong dollar can do any number of things. Number one, it can make the U.S. more interesting from an investment perspective, and therefore bring capital and opportunity into this country. The other thing it can do is it can make U.S. goods less interesting relative to foreign goods. But the big caveat there is that foreign countries have to make goods. And guess what? They don't have any oil to make them with right now. So there is that, you know what I mean? It can, to the extent that we become increasingly innovative and increasingly and just high grade the things that we make, which we've done historically. And there's evidence that we might be doing that given where the semiconductor business is coming back on. Sure, the strong dollar should be, I don't want to say it's nothing, but it's not it's going to when you high grade what you make, it has a bigger impact than the minor fluctuations of currency, especially if the thing you're high grading is something that can make everybody a lot more productive. And then the other thing that it can do is it can lower the price of goods for all Americans by making foreign goods more interesting. And so then you should see some changes in the export number. And the only thing right now,
it would hurt our exports.
It would potentially hurt our exports if it wasn't that there was a gigantic shortage globally. I think that's what people are trying to, how do I say this in the nicest possible way? What's happening right now is you could look at past, we start to show off with past performance is not indicative of future returns for a reason. You know what I mean? This current scenario is not set up like any other time. If we want to look at the 70s, well, the 70s is still, you got this residual nastiness from World War II, such that you got all these nations that couldn't have any kind of consumer ability or anything going on, right? You have like Latin America, hot mess, totally America's fault. Let's just call it what it is, right? Europe's still recovering. We had war in Asia. Do you know what I mean? Like, you can't compare that to the 70s. That's not what's going on. And so then who would we have exported to at that point? You know what I mean? Was the dollar strong? Heck yeah, it was strong. It was almost 80-90% of reserve currency for everyone. Why? Because World War II was what it was. Okay, now we want to compare it to 2022 and pretend like there's a comp there. There is not. We certainly can't use 2008 as a comp because the financial system was what was getting attacked during that period of time because of poor management. Well, guess what? We don't have poor management this time around. So you know what? It's really hard. And then, the shortages that are underway is really driven by the one thing that the United States is so high stacked coming into this game. So high stacked. We got plenty of energy. We don't even have to really burn, how do I say it? Even if we're burning coal, we're burning less coal than we would have if this had been an issue in 2008. Let me say it that way. But even then, that you really can't compare it to that because we had not figured out fracking at that point. So we might have been burning a lot of coal for that reason, but when you look at it, we're so high stacked at the table. I don't know another way to say it. We got plenty of food. We got plenty of energy sources. I was with someone chatting the other day and they were getting really enervated because they were like, nuclear, we don't have any of it. I'm like, look, do we need more of it? Yeah, it'd be amazing if we would move closer and closer to nuclear because it would lower the cost of fuel for generations to come, especially given the advances that have happened in the last 40 years, let's call it, on nuclear, okay? Unambiguously would be the best long-term solution for America, but we got the not in my backyard. And then there is some things that you have to deal with as relates to nuclear waste. I'll give it to them. But nonetheless, even without nuclear waste, we got a friend joining us a little late here. But even without nuclear, we do have, we're low cost producer of liquefied natural gas right now, unless, we're the low cost producer of oil onshore. We got plenty of coal, we just have to get it from point A to point B, which is not insignificant for this particular country. We got pretty much every natural resource that you could want on these beautiful places, and we got low population density. And on top of that, we got plenty of farmland. Now, we got some issues with water for sure. We've already been working on shifting towards renewable, which will then decrease the need to potentially use that coal. We're high stacked at the table. You can't compare us to the rest of the world. And then when you're looking at a situation where you got other countries that are big producers of things like electrical stuff, let's call it, all right, washer, dryers, etc., appliances, all that stuff. Do I think that we're going to go through some funkiness? Yeah. Do I think that Europe's going to be able to produce all that stuff better than American can, sitting there with no fuel? No, I do not. So it's really hard to know exactly how this plays out. Hence, I don't know how the next quarter is going to be. That was a really long explanation. I apologize. But the last, like 2008, cool. That wasn't the issue, like 2008, Russia wasn't cutting off energy to continental Europe. so it would look a little different. And also Russia, Ukraine wasn't cutting off food supply to them either. And also, by the way, they hadn't decommissioned their nuclear yet at that point. So it's a very different picture.
Got it. Okay. So energy still looks cheap.
Yeah,
Supply side.
energy looks cheap. If you're trading it, and it's tough, I would still go for those that have a dividend yield for sure. Just so that the dividend protects you. Most of the companies have announced some sort of stock buyback. The exception to the one company that has not yet pulled the trigger on stock buyback is EOG. But they were less aggressively negative about it than they were this last quarter, or than they were in the second quarter, the February quarter. In the February quarter, adorably enough, 3 days before Ukraine war was declared, they were like, we're going to save it for CapEx. And you're like, what are they trying to tell us? We're going to save it to CapEx. Here's a little map of us shipping all of our LNG to Europe. If you look back at my February videos, you'll see my review of EOG and what they said on the quarter. So I think at this point, it'll be interesting to hear what all of them have to say and how they want to deploy capital, because sure enough, they do have it to deploy. Any other questions?
No, I'm just Devon. I mean, aren't they very attractive from a even an earnings standpoint?
I personally think Devon is very attractive. This market appears to want to trade it down. I'm not necessarily, look, to be fair, in this marketplace, I'm trying to trade a lot less and just take opportunities when they come in, like fish swimming into a boat. With stocks like Devon and IEP, Icon, Carl Icon's really able, he bought that refiner so cheap, and you and I've talked offline on this. So he has plenty of cash to pay that, what is it, 15, 16% dividend yield. Devon at these levels is paying you over 10%. And here's the deal. Even with the day trading, as fun as that is, whatever, I like 10% dividend yield. I'm not going to lie. That's really sexy to a girl like me. FYI, I'll just say it so we can use this clip later. 10% dividend yield, I don't think people appreciate what that is all about. That's about long-term wealth building. So you should take retirement money that, given that there's no risk to this dividend, right? The only real risk is if suddenly this becomes, but even then, energy just becomes more interesting, not less interesting. But a 10% dividend yield is a 10% dividend yield, fair and square. And refining capacity.
IEP is 16%.
Correct. Both of them, fantastic.
Right.
And good for the long term. So those you should just.
Yeah, that's a good point. Buy stocks that they pay you to own them. It's like real estate rentals.
Absolutely.
They're paying you rent.
Look, you can't get a 15% cap rate right now, and you sure as heck can't get a 10% cap rate even. When I was home, people were looking at 4% cap rates. So yeah.
Cool. Great point. Okay.
All right, guys. I'll see you tomorrow. Just be careful.